Hey everyone, and welcome back to NIM's Adventures to Financial Freedom. Today we're diving into a high-yield ETF that's gone through a full transformation, and it's now one of the most talked-about funds in the income investing space. Meet ULTY, the YieldMax Ultra Option Income Strategy ETF. It's been delivering weekly payouts, with an annualized yield of around 85%. But this isn't the same fund it was when it launched. Back in early 2024, ULTY launched with a bold strategy, and within a year, it lost nearly 70% of its value. That triggered a complete transformation in March 2025. So, in this video, I'll break down what changed, how it's performing now, what risks still exist, and how I personally use it in my dividend strategy. Let's get started. ULTY is an actively managed ETF launched by YieldMax on February 28, 2024. It currently manages around $2.9 billion in assets, with a 1.30% net expense ratio. Its goal is to generate high income. It does this by buying a basket of 15 to 30 high-volatility U.S. stocks and writing covered calls on them. This strategy allows ULTY to collect juicy premiums, but it caps the upside and still carries meaningful downside risk. So while you might collect weekly income, a steep sell-off in the underlying stocks can still drag ULTY's NAV lower. Let's talk results, starting with ULTY's original structure. When it launched in February 2024, ULTY traded around $20 per share. But over the following year, the fund experienced severe NAV erosion, falling to just above $6 by March 2025, a nearly 70% decline. This wasn't a short-term dip. It reflected structural weaknesses in the original strategy, an aggressive option writing model, no protective puts, and a heavy concentration in volatile names without enough risk control. Even though it paid sizable monthly dividends, those payouts couldn't make up for the plunging NAV. This underperformance is what ultimately led to the March 2025 overhaul, where the fund revamped its structure from top to bottom. Here's what changed. First, distributions switched from monthly to weekly, starting March 13, 2025, giving investors more consistent income. Second, the option strategy was revamped, adding protective puts and allowing more tactical flexibility through synthetic positions. Third, the holdings became more flexible. ULTY can now hold anywhere from 15 to 30 individual stocks or ETFs, instead of being limited to synthetics. Fourth, the expense ratio dropped from 1.40% to 1.30%, thanks to a fee waiver that's in place through February 2026. And finally, the prospectus was updated, with clearer disclosures about NAV erosion, high turnover, and potential liquidity risks. Together, these changes helped stabilize the fund's behavior, and for many investors, redefined its identity entirely. So, how's it doing now? Since the March 2025 changes, ULTY has outpaced the S&P 500 by over 15%, delivering a total return of more than 30%, compared to just 15% for SPY, while still paying weekly distributions of 9 to 10 cents per share. That kind of rebound, paired with the structural overhaul, has shifted how the fund is perceived. Some now consider ULTY a brand new ETF, more dynamic, more risk-aware, and in many ways, acting like a mini hedge fund in an ETF wrapper, rotating volatile names, tactically managing options, and delivering aggressive cash flow. Want to know what powers those returns? ULTY goes straight for the names with the biggest swings and the juiciest premiums. We're talking Coinbase, Robinhood, MicroStrategy, Palantir, and even newer high flyers like AppLovin, Upstart, and IonQ. These aren't your typical blue chips. They're hyper-volatile stocks with options that command serious premiums. ULTY writes covered calls on these names, sometimes synthetically. And since March, it's added protective puts to help guard against sharp drops. Put it all together and you get what this fund was designed for: high weekly income, especially in choppy or sideways markets. Now, let's talk about the risks. The fund is still exposed to market drops. If stocks fall hard, your principal will too. Covered calls cap your upside. You trade growth potential for steady income. Most payouts are classified as return of capital, This can be tax-friendly, but if option income falls short, the share price may erode. If volatility dries up, option premiums shrink. That means payouts could fall quickly. But now for the good news. From March 13th, when ULTY's strategy overhaul took effect, through the market dip following Trump's tariff announcement in April, the S&P 500 fell more than 8%. ULTY? It dropped just under 7%. That's a solid result for a fund packed with high volatility names, and a sign that protective puts likely helped cushion the blow. Bottom line, ULTY can turn market swings into cash flow, but it still carries equity-level risk. The April 2025 pullback shows it can hold up better than expected. Yet, it's not immune to losses. Let's talk about the future. ULTY has massive yield potential, but it comes with serious risks that investors need to understand. The weekly payouts alone could return your entire investment in just 64 weeks. At recent prices, around $6 a share, and a payout of roughly 9 to 10 cents a week. That math checks out. It's a compelling stat, but it assumes those payouts stay steady and that the share price doesn't collapse, both of which depend heavily on market volatility and option premium income. Let's run the numbers. If ULTY continues paying about 9 to 10 cents per share each week, and you bought in at around $6 per share, a $10,000 investment would get you roughly 1,666 shares. At an average of 9.5 cents per share weekly, that's around $158 per week, or roughly $685 per month. That's over $8,000 a year in income on just $10,000 invested. Now imagine scaling that up. A $100,000 investment at those same rates would generate approximately $1,580 per week, or around $6,850 a month in pure income, more than the average U.S. salary, just from dividends. And yes, I'm repeating myself, because it's that important. This only works if payouts stay steady and the share price doesn't collapse. That's not guaranteed. But when conditions align, ULTY shows just how powerful high-yield income can really be. So what's the ideal scenario? ULTY performs best in sideways or slightly bullish markets with high volatility. That's when it collects premium after premium and avoids getting hit too hard on the downside. But in a prolonged downtrend, or if volatility dries up, distributions shrink, NAV decays, and your high yield gets wiped out by losses. Bottom line, ULTY is a tactical income tool. It's for investors who want aggressive cash flow and know how to manage risk when the ride gets rough. As someone who bought ULTY shortly after it launched, before the March changes, I've seen both sides of the story. Back then, NAV kept sliding, and I lived through the worst of it. I'm still sitting on a loss in that original position. But since the fund revamped its structure, performance has noticeably improved. That's why I'm planning to expand my position. I'll still be watching closely to see how ULTY performs going forward. But with the updated strategy, consistent income, and better downside control, it's earned a spot in my high-yield income rotation. So, is ULTY a buy? That really depends on what you're looking for. If your goal is weekly income, if you're looking for a high-yield investment, and you're comfortable with high volatility exposure, then ULTY might make sense for you. But if you're aiming for long-term capital growth, or you prefer simple, set-it-and-forget-it strategies, this probably isn't your fund. The key is knowing what you're holding and being clear on what it's giving you and what it's quietly taking away. As always, remember to do your own research and consult a financial advisor before making any investment decisions. Are you currently holding ULTY or planning to buy it? Let me know in the comments below. If you found this video helpful, don't forget to give it a thumbs up, subscribe, and ring the bell to stay updated. Also, feel free to share this with others who might benefit from these insights. It helps us grow and continue this journey to financial freedom together. Thanks for watching, and I'll see you in the next episode of Nim's Adventures to Financial Freedom.